Thinking about investing but have zero experience? You're not alone, and you don't need to be an expert to get started. In this video, we'll walk you through Start Investing with Zero Experience, a step-by-step guide. From understanding the basics to choosing your first investments and managing risk, we'll break it all down into simple, actionable steps. Today, we will talk about Start Investing with Zero Experience, a step-by-step guide. So before we get started, make sure to hit that like button, also subscribe to my channel. Investing can seem like a complicated and intimidating world, especially if you have no experience at all. You might think you need a lot of money, advanced knowledge, or a special background to get started. But the truth is, anyone can begin investing, even with zero experience and very little money. The key is knowing the right steps to take and building confidence slowly. 1. Understand why investing matters. The first step is to understand why investing is important. Saving money in a bank account is safe but usually doesn't keep up with inflation, which means the value of your money can actually decrease over time. Investing allows your money to grow by putting it in new assets like stocks, bonds, or funds that can increase in value. Over the long term, investing is one of the best ways to build wealth and reach financial goals like buying a home, funding education, or retiring comfortably. Knowing this helps you see why it's worth learning to invest early. 2. Educate yourself about basic investment concepts. Before putting your money into anything, it's important to learn some basic investment ideas. Start with terms like stocks, bonds, mutual funds, exchange-traded funds, ETFs, dividends, risk, and return. Stocks represent ownership in a company, and their prices can go up or down. Bonds are loans you give to companies or governments, which pay interest over time. Mutual funds and ETFs pool money from many investors to buy a mix of assets, offering diversification. Risk means the chance you could lose money, while return is the profit you hope to make. Understanding these basics makes investing less confusing and helps you make smarter decisions. 3. Set clear investment goals. Every investor needs clear goals. Are you investing to buy a home in 5 years, save for retirement in 30 years, or build extra income? Your goals affect your investment choices. If your goal is far away, like retirement, you can take more risks for potentially higher returns. If your goal is soon, you'll want safer investments to protect your money. Setting goals helps you decide how much to invest, how often, and what kinds of investments suit you best. Clear goals give your investment plan purpose and direction. 4. Check your financial health. Before investing, make sure your personal finances are in order. This means having a budget that covers your income and expenses, an emergency fund with 3 to 6 months of living costs saved, and manageable debt levels. Investing without an emergency fund can force you to sell investments during a market downturn, which can lead to losses. Also, high-interest debt should be paid off first because the interest you paid is usually higher than investment returns. Being financially healthy means your money can stay invested for the long term. 5. Start small and be consistent. You don't need a lot of money to start investing. Many platforms allow you to begin with just a few dollars. The key is to start small and keep investing regularly, even if the amounts are modest. Consistency is more important than large sums. This approach is called dollar cost averaging, where you invest a fixed amount regularly, buying more shares when prices are low and fewer when prices are high. Over time, this reduces the impact of market ups and downs. Starting small also helps you learn without risking too much. 6. Choose the right investment account. To invest, you need an account with a brokerage or an investment platform. There are different types of accounts depending on your goals and location. For retirement, there are tax-advantaged accounts like IRAs or 401(k) in the US or RRSPs and TFSAs in Canada. For general investing, taxable brokerage accounts work well. When choosing an account, consider fees, minimum deposit requirements, ease of use, and available investment options. Many online brokers offer user-friendly apps and educational resources, making it easy for beginners. 7. Diversify your investments. Diversification means spreading your money across different types of investments to reduce risk. Instead of putting all your money into one stock or asset, You buy a mix of stocks, bonds, and funds. This way, if one investment loses value, others might gain or hold steady. Mutual funds and ETFs are popular ways to get instant diversification because they own many different assets. Diversification helps protect your portfolio from big losses and smooths out returns over time. 8. Understand and manage risk. Investing always comes with risk. Prices can go up or down, sometimes sharply. The key is to understand your own comfort level with risk and invest accordingly. Younger investors with a long time horizon can usually take more risks because they have time to recover from losses. Older investors or those with short-term goals often prefer safer investments. Managing risk also means avoiding emotional decisions, like selling during a market drop. Sticking to your plan through ups and downs is essential to long-term success. 9. Keep learning and stay patient. Investing is a lifelong learning process. The market changes, new investment options appear, and your goals evolve. Stay curious and continue educating yourself through books, podcasts, reputable websites, and courses. Avoid chasing hot tips or trying to time the market because this often leads to losses. Instead, focus on steady, disciplined investing. Patience is one of the most valuable qualities for investors. The power of compounding, earning returns on your returns, grows dramatically over time. Staying invested and patient lets your money work harder for you. 10. Review your portfolio regularly and adjust when needed. Even automated investing requires occasional check-ins. Review your portfolio at least once a year to make sure it still fits your goals and risk tolerance. As you get closer to your goals or your financial situation changes, you might need to adjust your investments. This could mean shifting from higher-risk stocks to safer bonds or increasing your savings rate. Rebalancing your portfolio helps keep your investment plan on track. Remember, investing is a marathon, not a sprint. Regular reviews keep you moving steadily forward. Starting to invest with zero experience doesn't have to be confusing or scary. By understanding why investing matters, learning the basics, setting goals, and starting small, you create a strong foundation. Using the right accounts, diversifying your investments, managing risk, and staying patient will guide you to long-term growth. Keep learning and reviewing your portfolio regularly to stay on course. What do you think of our video? Let me know in the comment section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.